welcome everyone to the Trade Speakeasy. And I hope you guys are actually able to see us live on YouTube. Apologies for the delay. This is our first time doing this, and we're trying to coordinate between multiple computers. So today was a crazy day in the markets. And for those of you who are already in the Jade Lizard room or the butterfly room in the Telegram, you already heard a little bit about what I was sharing regarding why we're having so many kind of blocked off days. So for those who trade price action, sometimes, you know, you're looking at the market from like the Forex currency and future side, and then sometimes looking into the indexes and options window. And then for those of us who trade mostly focused on the indexes then, or with options, and then we're looking actually at the futures and currencies in order to support our directional bias. So we have been trapped within a very narrow range because it was quite obvious that as we were coming up into this options expiration date coming next Friday, and then CPI release that was happening before the market hours today, that there was a lot of trepidation. And so oftentimes, you know, we don't know if when we're looking at the option chain, we're looking at where those major kind of ledges are, where those big open interest areas are, but we don't always know exactly when people put those positions on or those institutions. So we don't know specifically if that is short covering, or like if those are short calls or long calls, or if they're long puts or short puts, or if they're structured maybe in a credit spread or a debit spread to the put side or to the call side. And so for a lot of people, because they're used to focusing on the movement of the price, that sometimes that kind of, let's say, the iron structuring that's inside the building, it's not as necessarily important when you're just trying to move from, let's say, the ground floor to the first floor. But when you're like moving up and down the floors and you're trying to go in and out of an elevator, you want to know that the iron structuring makes sense so that you kind of know where those weak areas are. Because if it's a skyscraper and you have a bad architect, you know, wherever those weak spots are, you're going to want to pay attention. And so basically what ends up happening is that when price starts to move towards one of these major ledges, what reveals the position of the broker is how price responds at those areas. So oftentimes you might see actually at a certain strike price that you have both on the call and the put side a large amount of contracts, but an equal number of contracts. And so that can actually create this rotational feeling that like price kind of comes back up, like goes up above a point and then comes back down right below it and up and then down, and then is just like rotating around kind of an axis, or this major point. So today we had something really incredible that happened basically. And that's it. We had, for a long time, we had a lot of contracts of long puts that were really far out the money, like the JP Morgan collar trade that we talk about, so that we often talk about, but that's so far out in the duration that it's not really interacting that much with the price, because it was down at the 3,400 on the SPX, and we can just like place a line here so that we can see, but it's actually, its expiration date is so far away that it's not pushing or pulling us, because oftentimes what you need is that the price is expiring into a major gamma area or a major open interest area for it to start creating kind of stronger magnetization or a stronger pull. And what we had was a lot of open interest at this 3,500, a lot of long puts that had been at the 3,500. And in the beginning of the week, though, really our major support area was this 3,600. And we hadn't seen enough people come into that 3,500 to push us all, to basically take those support areas and collapse them into one major support area. So every time we were getting down to this like 36 3600 area and 3650, those major open interests were large enough that price just kept moving between them and around them. And it was very frustrating because we were just getting a lot of sideways days. And if you weren't positioning your options contracts really perfectly, you could end up, not getting the perfect positioning, paying maybe too much for your strike, or not paying enough for your strike and being slightly too far out the money to actually catch the move. But this is a crazy rally. I mean, 4.2% is a significant amount. And this does not happen often. So I know a lot of people felt frustrated, like, oh, I didn't catch it. It's such a big move. And yeah, it is such a big move. But you do not want to create your trading journal based on exogenous events. So, I'm sure that there are like millions of people that, if it was an earthquake or some terrible event, that they're like, oh man, I really wish I would have kind of planned better for this one really big event that was going to happen. But actually, you don't want to live every day of your life with that intensity of stress, whether it's positive stress or negative stress. What you want to do is you really want to stick with your trading journal. You want to have a setup or a trading plan that makes sense day in and day out, and then not be angry with yourself when maybe you don't catch a 4% move, when literally for the last 3 months, the SPX has been sitting really within its one standard deviation. So it has been staying within its major range. And you don't want to be like making trades where you're consistently thinking today's the day that it's going to make this huge move. Because then when it doesn't, you also feel frustrated because you may have been in a positive trade that you've let go red, expecting that you were going to get this outsized move that didn't actually transpire. But so as we were coming into yesterday's craziness, we started back where we were heading back to this 3650 area that has been a key overhead support area. And that short covering, because those are short calls, and we know that because as price tries to move away, it draws the price back. And that's because the broker is holding the opposite side of the trade. And so every time you have any short covering, the natural reaction to price is that it will run up or near that short call area. And then every time it tries to move away, then because people are either closing up their short covering or the broker is now at neutral, and so they don't have to move as many shares to keep the balance of the books. So what ends up happening is that then you end up getting kind of a pull away. But if that short covering is still there with the same amount of contracts or size, then it will continue, the magnet will continue to remain strong. It only gets weaker. And oftentimes you will hear when we talk about charting patterns, like you have this overhead resistance and look how many times we touched it. And so that touching is supposedly something really imperative. But actually what the touching is saying is that price came up to it, people removed some of their contracts, or they actually placed contracts to the opposite side. So maybe they had short calls and now they're going to go in with long puts because they see that price is now coming up to them and might respond, or they just close those short calls. So every time price kind of retouches, it tests the bravery of the people that are holding those tens of thousands of short contracts where price is now touching and maybe even breaching their short position and causing them to face a loss. So because we just kept coming back to that area, it showed us that even though we have puts coming in, they're not coming in at a fast enough pace. So people are happy to sell the rips, but they're not actually buying any covering they're not buying enough long positions to the downside. But when the Bank of England, very surprisingly yesterday, came out and announced that they were basically willing to face off with the UK government, with the PM Truss's government, that it signaled to the world that this idea that the Bank of England is going to allow, just kind of turn a blind eye to anything that looks like stimulus or anything that looks like quantitative easing. Governor Bailey was like, nope, I am putting an end to this. I want to signal to the markets that I'm very serious about quantitative tightening. And if the government chooses to ignore my sign to them, that will be to their detriment. And then they will have to face the voters. They will have to face the public, maybe in the next election cycle, to explain to them why they allowed part of the pension system to essentially fail. Because by the UK government coming out and signaling any kind of potential stimulus, it gave people this fear that that the Bank of England is going to step back in their quantitative tightening cycle, and that they would be willing to come in and save the bond market. And when they said, no, we are not going to save the bond market, it is the government's job not to put the pension system in a situation where they will cause the bond market to fail. And that is an internal struggle to the government, and Parliament needs to figure that out. And so then everybody was expecting that that PM Truss, that she would back down. But actually in their live debates in Parliament, she was actually quite strong, that she had no interest and she was not going to step back any of what she said about tax cuts, which were basically seen as stimulus. So this is why we got this kind of sudden rejection to the downside. That was when you see these big moves, it is because there's something comes out that the market really wasn't expecting at that very particular moment. And so that's why we had the big push down. And when that happened, that made enough people nervous enough that then they started buying puts at that 3,500 level, which we actually hadn't seen enough of, because there were too many long puts at the 3,600 level. But when we saw this basically strong breach and then this kind of rotation around the 3,600, people took off their long puts and rolled them down to the 3,500. Now, the thing is that then when CPI numbers came out this morning, that gave us this massive drop to the downside and literally put us right on top of that 3,500. And when that happened, in my morning note, I said, if we do not drop past the 3,500 with true conviction, then what it means is that the broker is actually going to have to start hedging against this data point. So the broker is holding all the positions on the call side and on the put side. And if price doesn't keep moving to the next significant level, then the broker has to come in and he has to start basically covering his position, because now he's suddenly massively delta negative. So he's basically in the hole for all of those long puts that were, so all of these 3,500 long puts were at maybe like a 25 or 30 delta last night. And when everybody woke up this morning, well, almost spilled my tea, that all of those were at a 50 delta, which is a massive change for the broker. And so that means that the broker has to start basically evening out his books, which then gives this kind of echoing cycle where suddenly you get a lot of push to the upside. And then as you see, we close the gap. And then we didn't really know what we were going to do at 11 o'clock. And that 11 o'clock time in the United States, Eastern Standard, is extremely important, because that's actually when the London and the European offices close. So everything that they're doing in the futures market and in the options market, they have to close out all of their positions. So that 11 o'clock point is their settlement point. And that's why often we see kind of these lulls. But what it did is, when there wasn't a rejection, or basically that we didn't go back and fill those massive bullish candles right at the open, basically meant that then the US market participants were like, wait a minute, we could still be seeing more upside. And this is then where we started seeing, and you could see in the contracts that all the contracts that were filling up were in the slightly out the money calls on all of the indexes, basically. So people saw that this big bullish move has happened. The broker has basically tapped in to balance his books. And so we want to ride the wave up, and that's what sustained us. Now, the question is that going forward into options expiration next Friday, are we going to see a continuation? Does this rally have legs, or are we going to come back down and drop back to the 3,500 first? Like, which direction is Gamma going to take us? And I think that options expiration has kind of given us a hard ceiling at the 3,700 and also at the 3,800. But for this Friday's expiration, but for options expiration, our major overhead resistance is actually all the way up at the 4,000, and now our below support is down at the 3,400. So those are the key levels that we really have to be thinking about how price is moving either bullishly or bearishly. But those are really the key targets that price is going to need to satisfy, because that's where volatility is going to be driving us. So we could continue to see crazy days like this, but I think that but the question is, it's still unclear if that drive is going to drive us down to the gamma ledge at the 3,400, or if it's going to drive us up to that 4,000. Now, the reason that this is really important is that usually we have more kind of support and resistance areas in the options market that give us a bit more clarity that price is going to get to this point first and then maybe come back to a closer level. But when you have the main superior support and resistances so far away, it can cause like these really big moves, because it means that volatility is looking for that stop point either in front or behind, because that's all the race car can do. That's all price can do, right? Is it can go fast with volatility either to the stop point ahead or reverse backwards to the stop point below. And if there's nothing sitting between that, there's no speed bumps, there's no lights, there's no nothing kind of giving it a kind of even like a flowish resistance, like going against the current, those moves can happen very aggressively and very quickly. So that's where you want to be a bit kind of, you want to be really paying attention. And that's why I always suggest to people, look at the option chain. Like, even if you don't trade options, it doesn't matter. Just look at the option chain, because the laws regulate that broker dealers, market makers, anyone that's providing is on the opposite side of like providing liquidity into the market, that the dealer sitting between all of those actions has to be delta neutral. So it means that they cannot be long or short the market. And so when we have these really fast moves, the broker suddenly has to rebalance his books to get to neutral. And that's when we start getting these massive whiplashing. So that's why you saw overnight, we had a huge move to the downside. We opened right at that 3,500 support that I highlighted. And then we literally sprinted up to the next major overhead resistance. To be perfectly honest, I did not expect to see a 4.2% move, just because that is way beyond, like, I think that's more than a 3 standard deviation move. So we literally moved more than what the market expects it, almost like an entire week, just in one false sprint. And you don't want to be whipped out on those kinds of trades, because you can rack up losses very quickly. So I know we got started a little bit late, and I really want to respect your guys' time. And I just wanted to thank you guys for joining us. If you are on YouTube Live, thanks for joining us for our first live presentation. And I will pass the time back to my wonderful colleague, Jay, who is going to be taking you guys through long puts. But as always, if you have questions, hop in the Telegram groups. hop in the chat, write out the comments. We promise we'll get back to you with answers or point you in the right direction for more information.
Suzanne, thank you. That was awesome. It's a masterclass. Really appreciate it.
You're very welcome. I'm glad to be here with you guys. So I will bid you guys adieu since it is 1:30 in the morning. And
Oh, goodness.
on to you, Jay.
Awesome. Awesome. So going into this presentation, we will be discussing puts. Obviously, today was not a great day to enter a put. It was a great day to exit a put, which is what Suzanne did. If you were paying attention in the Telegram. With that being said, I'll be going over the basics of the puts to start this presentation. And then towards the end of the presentation, I'm actually going to try to break down the trade that Suzanne outlined. I'm going to try to show everybody what it looks like in the option chain, sort of show some pictures of what she was looking at in the market when she entered the trade, what she was looking at when she exited, and why using a vertical debit spread made sense to her. So if you're very new, the beginning of this presentation is going to help you to understand puts and how to trade, just the options basics. But as always in the Trade Speakeasy, we really like to define our risk by making sure that we put on option spreads. And so towards the end of this call, I'm going to talk a little bit about how to convert a long put into a spread, and just one of the ways to think about it, looking at the option chain so that it feels simple. All right. As always, we have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There's a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you can't afford to lose. Options trading is not suitable for all investors. I wanted to start today with a few quick bibliography and acknowledgements. TD Ameritrade webcasts, and also just if you use Thinkorswim, TD Ameritrade's actual website has a great options education. And so I would just encourage everybody to check those out. They're free. They're super helpful. Suzanne, when she starts breaking down the options chain and she starts looking at open interest and she starts talking about gamma ledges and really like looking at price action behind the charts, one of the tools that she uses is cheddarflow.com. And so she actually uses that subscription to really get inside of the option chain. So as you start to learn about open interest and start to get more curiosity around especially option ledges, Cheddarflow can be super helpful for that. Also, the TradingView community has a ton of free resources, and it's just a great place to, you can always jump onto Telegram and ask questions. You can also just go to these resources and oftentimes find things to help spark your curiosity. I think that the ongoing gift with Suzanne, one of the first things she ever told me was to never stop learning. And whether I have a great day in the market or whether I have a controlled loss, the thing that helps me to continue to grow and to continue to have confidence is that love of learning. So we just wanted to share these bibliography and acknowledgements today. Okay, long puts is an option contract. It's essentially a bearish option contract. That's what we're trying to do. So when we buy a call, we're buying an option that has a bullish thesis. When we buy a put, we are buying an option that has a bearish thesis, and we are securing the right to put up for sale 100 shares of the underlying. The way I like to think of it is when I buy a put at any given strike price, it means that I can actually take that, just bear with me, I'm taking that 100 shares and I can actually put that in whoever sold me the puts account. They are taking on the risk of me putting 100 shares in their account. And so it means that in a sense, just like if I were to short shares and I would have to sell to open, it means that I'm in a short position. The big difference between buying a put and shorting shares is when you buy a put, when you are long a put, you are in a bearish position. You are not in a short put. So that was something that confused me at first. So I learned bearish trading strategies first by understanding how to short shares. And so at first I thought like, oh, if I want to be short, if I want to see something go down, I want to be short a put. If you are short a put, you are actually, that's a bullish scenario. We're not going to talk about that now, but just know and understand a long put is a bearish trade. And so if you're very new, I want that to stick and just have something that stays in your memory bank. A long call is bullish, a long put is bearish, but both strategies you are buying to open. And so at any time before market close on the expiration date selected, you can close this contract. All right. The purpose, buying to open a put option, is based on a thesis that price of the underlying is decreasing significantly below current price. And underlying is the equity index or instrument being analyzed for price action. Today, just like last week, just like probably always, we will be looking at least when I'm teaching, we'll be looking at SPY for our example. And I like to look at SPY because it is the market. And if I can have a great understanding of what S&P 500 wants to do, then it's a lot easier for me to trade anything else in relationship to it because I have a great understanding of market momentum. So when I'm teaching basic strategies, I like to really focus on just one underlying, and that's going to be SPY. But I promise, for anyone who hasn't done it before, if you really invest a lot of times understanding what the S&P 500 index is doing, it makes trading anything else that you want to trade, it puts it into a context. Now, obviously, the market landscape, when thinking about buying a put, you want to see the price of the underlying is bouncing off of a strong resistance level. The underlying is approaching low seasonality, or there is a technical bias towards a price drop, or there has been a pre-earning run-up that is likely to be tested. Strategy for entry or the buy to open. Market dynamics at entry. You want to buy to open with enough time, which is the theta is the Greek representing time for price to make its move. Buy when volatility is low. So you don't want to buy right when the market is open. It's a great time to sell when the market is opening, not a great time to buy. So afternoon entry when volatility has dropped. Tuesdays when stocks tend to pull back. Tuesdays we tend to get, if the overall trajectory is in one direction, Tuesdays tend to give us sort of a breathe in the opposite direction that can offer an opportunity to fade. Not every Tuesday, of course. It's never that predictable, but oftentimes. We want to enter when IV rank and historical volatility are low. Enter when the underlying is in a bearish or low seasonality. And you can check seasonality at stockcharts.com or seasonx.com. And so for our example, actually we have two examples today. This is the one that I prepared in preparation for this class. And I went into my Thinkorswim platform and tried to give us an on-demand view of the market opening last Friday, which is like, this is like a beautiful mirror image to what happened in today's price action because it's really different. We had a gap down on Friday, but also I want to draw your attention to this blue line. And this blue line is the 20 simple moving average. 20 simple moving average, you can see that historically, at least recently, we've been respecting as resistance. And so just one thing that maybe we could have noticed last week before the market opened on Friday, we would have noticed that not only Thursday, but also Wednesday before, we have these long wicks that are fading away from the 20 simple moving average. And so in our mind, or at least if you trade like me, you'd be thinking like, okay, maybe I can start to have ideas of attacking the lows, 357. But, and this is how I don't have the same stomach as Suzanne. I knew that we were getting non-farm payroll out on Friday. And so I didn't want to enter a swing position before that. So I wanted to wait until Friday actually opened before I thought about entering the trade. And so this is what, when Friday opened, we had a big gap. The gap happened because non-farm payroll numbers were released. They were bearish. But think about today, just because you get a bearish figure at 8:30 a.m. Eastern time, it doesn't mean that the actual open is going to respect that. So there's two reasons why you don't want to buy right at the open. One of them is you don't have enough information yet to know which way the day actually wants to go. And the other one is there's because of that, because the market hasn't picked a direction yet, there is a ton of implied volatility. So your contract is going to be more expensive. But I'm going to bounce back and forth a few times from these two screens. If you were considering buying a long put at the open, notice that price is trading at about 368. And so I have the in the money put highlighted at the 368 strike price. You would buy the contract for $9.30. Always think in terms of option prices, but know in your mind, that means it's a $930 investment that you need to be willing to manage. The delta on this position, because it's super close to at the money, is almost 50 cents. It's 47 cents. That means, and notice it's a negative delta. If you have a bearish thesis, you want to see an option with a negative delta, because it's telling you that as price goes down, your contract is going to inflate. So as price drops, that negative delta is going to add to the value of your contract. So that's what you want to see. You want to see a negative delta if you have a bearish thesis. Gamma is at 2 cents, meaning that for every dollar that SPY goes down, you add another 2 cents of value to your delta. So I always like to think of gamma as the delta of delta. Theta is 22 cents. Theta, you'll notice, is pretty high for the contract that I selected. It's only 21 days away from expiration. And the reason why I looked at this expiration is because if you look at this idea where we're bouncing off of the 20 simple moving average, we have this big gap down. The thought process behind a trade like this is we're going to start moving rather quickly. And I think that people who have heard me talk about trading know that I like to trade butterflies. I trade more weekly. So I am thinking like pretty quick motions, trying to get in and out of a trade, being okay if I'm wrong and just, letting it go for a small loss. But the idea behind just a 21 days to expiration is we don't necessarily have to pay a ton if we know that we'll get out quickly, if we know that we're wrong, and that we know that we're really not planning on staying in this trade for very long, okay? But what I want to point out is right at the market open, this contract price is $9.30. And like I was alluding to before, just the habit of trying to wait when you enter, you don't want to enter right at the open of the market, because one, you don't know which way the market's going to go, but also it's really, from a risk to reward standpoint, you don't have a lot to gain anyway. And so I'm going to try to get into that a little bit with this chart. Here's that same day clipped in 15-minute bars. And so notice that we have the open. Rather quickly, we dropped to 368 in the first 15 minutes. We break that. And then for the next hour and a half, up until about 11 o'clock, price actually trades sideways. And so we're down at about 367. Let's call this 367. It's just a few cents off. We're not making it all the way back up into the open, but we did lose some of that morning volatility. So now if we look at that same strike, and so again, we're looking at the 368 strike. Once we've had price settle down a little bit, we can see that now, okay, price has dropped. We're now at a 50 delta as opposed to a 47 delta. But we're only paying $10.08 to get into this trade. So it's about, it's about it is an 80-cent difference. But the point that I want to make is you have not only way more information, but price has dropped $1, and you don't have to pay that much more to get into it, and you have a little bit more information. And so with the idea of bouncing back to, hey, I'm getting in somewhere around here, I want to target way down here, it makes all the sense in the world to take a little bit of time and figure out that direction. And then if I'm going to try to find where, yeah, so this is just to contrast it to today's price action. Imagine dropping today, buying a put right at the open, having no information, paying the extra volatility charge, and then having it just scream right up in your face. And so I think that at 11 o'clock on today, if you contrast that with 11 o'clock, let me see if I can find it quickly. You contrast that, just the way that chart looks with 11 o'clock last Friday, it still makes sense to have a bearish idea here in ways that it did not have, the ways that it did not make sense to have a bearish idea at 11 a.m. today. And so just the two things that you want to think about when you're thinking about when to actually enter the trade. So with that, I'm actually going to stop my share for a moment because I've talked for quite a long time, just to see if there's any questions, anything that I need to clear before I talk about how to exit the trade, and then we get on to breaking down debit spreads. So we're a little bit of a quiet group today. I'm going to and still just give everybody a chance to ask questions if necessary. I will be jumping right back in a second. I got to tell you, when my head is still spinning from everything that Suzanne said, I can't wait to watch the recordings when they come up, because I was like, man, I have to take notes there. So for sure, sometimes it's as you get a presentation, the questions don't come right away. So please, if something comes to you and you feel like you missed it, by all means, reach out to me in Telegram. I'm always happy to answer questions, anything of that nature. But because it's quiet, I'm just going to go ahead and assume that we're ready to move forward. Okay. So the strategy for exiting, and you want to sell to close, it is a bearish position, but you do sell to close because you bought the put to open. So option one, you sell to close when your position has reached your profit trigger. We'll talk about that momentarily. Option two, have your profit trigger determined before entering the trade based on a percentage gain or numeric increase in the value. And so the easiest way to do that is to look at the price of your contract when you enter and say, you know what, I want to try to make 50% on this. Put a 50% profit trigger in. Make sure that that makes sense on the chart. So, make sure that you know that for every dollar your underlying moves, if you bought a 50 delta, then you can easily do the math to try to figure out how big of a move you're going to need to get there. But sometimes putting that profit trigger in, you will actually get out before you anticipate, because there's different times in the day where volatility can fluctuate, especially if you have like a big gap in one direction, or I should say, if you have a big gap that goes in your favor, chances are your profit trigger is going to be hit for you, even if it doesn't quite hit the price that you thought it needed to, just because of that influx of volatility. So option 2 is sell to close if price has made a strong move away from the relevant EMAs or a resistant level and retracement is likely. Sell to close when more than half the time has passed to avoid theta decaying in the value of your call. So you always want to buy with twice the amount of time that you think is necessary to get the move. And so that means that if you thought, so thinking, okay, I think this move is going to take a maximum of 10 days, so I'm going to pay for 20 days. Well, if 10 days happens and my move still hasn't gotten there, probably time to go ahead and close it. I can re-enter with a better contract where theta isn't going to just eat away at me. So always be willing to close a trade and jump into an option that's going to give you a better reward to risk scenario without theta ramping up, because we know that the longer we stay in an option, the more theta is going to eat away at it. And so this would be what I was looking at to close. So this was Friday's bar. Monday's bar, we are super close to 357. And for me, that's enough for my profit. So that is plenty of a move for me. And this is what the chart's looking like. I'm thinking, okay, we're close to support. It's time to go ahead and capture profits. And so with that 368 has now inflated to 15 cents. So we bought it for I'm sorry, $15, not 15 cents. We bought it for $10. We closed it for 15. Had we put on more than one contract, we'd be looking at over $1,000 in profit or more, depending on how many contracts we buy. But it's getting that increase because it's going deeper and deeper and deeper in the money. So the further that a put goes in the money, the larger that contract is going to inflate to. And that would be, to me, a great time to close this trade. I'm going to pause one more time because this is before we get into spreads. Just want to make sure that there's no questions in terms of entering and exiting. Cool. So very quickly, just want to go over the profit and loss scenario. This is the opposite of what you would see on a call. We want to see the underlying price get lower, and that is going to increase our profit. So underlying price gets lower, our profit's going to increase. And I think that should be pretty clear from what we've discussed earlier. A chart may indicate a decreasing price, buy option while the underlying is high, sell contract before expiration. And caution, if the underlying price increases, loss may be incurred, so always have an exit strategy. So here is just another way to look at it. And I think that, again, with this type of image, I just love the element of theta. They give us this picture of a clock, letting us know that as time is running out, that's going to eat away at our profits, but we're still looking for price to go down so that profits, pardon me, can go up. So the benefits when you enter a put, delta is increasing as price moves deeper in the money. Gamma is positive when at or near the money. Volatility increase expands the value of the long option. It's another nice bonus of buying a put is that oftentimes volatility, implied volatility, is going to go higher and higher as price goes down. So it's almost like a little bonus. If you can anticipate that price is getting ready to fall, when you go long on a put or a put spread, that influx of volatility is going to inflate your position. Risks are theta decay if price moves too slowly or not at all. And the gamma risk if the price move is insufficient for profitability before the option has passed the halfway point on its expiration. And so here we have just another bubble chart for long put moneyness. And so you can see that at the money, we have our put contract. The further that we get into the money, the larger the delta is going to expand. But for us to get deeper into the money, we need price to go down. And obviously, as price gets higher, if our thesis was incorrect, then that's when our put starts to lose value. It will lose value at an increasingly slower rate because delta is not going to expand, it's going to actually decrease, but that's not a reason to stay in the trade. That's just sort of something to remind yourself that it's not necessarily going to crush you as fast as it goes away, as it's going to inflate as fast as it goes towards you. And that's another reason when we get into talking about spreads, why debit spreads can be helpful, because you'll notice when you get into debit spreads that price is going to expand in your favor even faster than price is going to work against you, as long as you set that spread up correctly. So the purpose is during long seasons of low seasonality, long puts can be used by the investor to income generate, but also help mitigate any short-term losses for shareholders of the underlying. The investor believes the season of bearishness could last days, weeks, or months, and that's going to determine how long the investor buys a put for. All right. So this is going to jump us into Suzanne's Q's trade. And so I'm going to actually bounce back and forth from the position that she entered at and about where I think she was looking at entering the position initially. So she entered the position. She entered the position on Tuesday at about 3:30. So she entered at about when the chart was looking like this. Let me just see if I have a daily up. I don't. Give me one quick second. Apologies. I should have had that daily up, but I'm just going to get up my trading view so that we can actually bounce out and not only look at it on this smaller screen. So give me one quick second. Bring this into daily chart. Cool. And we're actually going to go to obviously, here's today's crazy price action. She was trying to target about 255 on Qs, but she got in around here on the daily. And that's where she was going short. She was going long puts, but she was thinking about shorting Qs with long puts. Okay. This was her entrance. So she actually had the full day to watch price action and was convinced that we were going to start to fall. And notice she didn't actually get in as price was falling. She waited for price to give her a little pullback that she could fade. So that's kind of the first cool thing that I noticed when she told me what time she entered the trade. She didn't try to just trade it as it was breaking out. She was saying, you know what, let me wait and be patient. She's just a great patient trader. Let me wait for price to give me a little bit better of an entrance, and then I'm going to enter. And so these were her strikes. She enters at 260 long. So she pays $4.51 for it. And the way I always like to think about debit spreads is Then she sells the 250. And when she sells the 250, she's giving herself a discount. And so giving herself a discount is doing two things. The most important, in my opinion, thing that it's doing is it's capping her max risk per contract. So she actually got in. This was like when I went into on demand, this was like sort of the closest that I could get to where she entered. But she showed me she paid $2.92. This contract, if you get in at the mid 450 versus $1.50, is going to come out to about $3.06. So the example isn't a perfect screenshot, but I think for educational purposes, it does its job. Just understand that when we're shopping for a debit spread, what we're looking at is enough of a difference in delta. So you can see that there is over 20 cents difference in delta. So that means that as price moves in Suzanne's favor, for every contract, for every, I shouldn't say contract, for every structure that she's in, she's getting a little bit more, actually about 25 cents of delta in her favor. So remember this 18 delta, if price is moving down towards that 250, because she's short this contract, that 18 is going to be working against her. So she bought this contract, but she sold this one. So for her, this negative 18 is actually a positive 18. And that's just something to take a moment and get our minds around. The contract that she sold is working against her profitability. And so at first, when I learned about this, I was like, why in the world would anybody do that? Just like have something that's working against their profitability. And the big reason is it's keeping costs down. So if Suzanne was actually wrong, and I'm thinking again about, if you remember at the beginning of this presentation, I was saying, man, I don't like to trade the day before I know numbers of some kind are going to come out. And so Suzanne knew that numbers were coming out today, but she structured herself with a risk to reward that she was okay with. And the way that she did that was by actually turning, not just going long on a put, but by saying, you know what, I'm going to turn this into a put spread. So when she bought this put spread, what she's saying is the 260 strike is the one that she wants to watch expand. And she's saying, you know what, as price goes down, no matter what, this 260 strike is going to expand in my favor faster than the 250 strike is going to work against me. So I'm willing to deal with the fact that this 250 is going to eat into my profits because I know that I'm getting 43 deltas in my favor versus 18 deltas not in my favor. That means I'm getting 25 deltas in my favor. And so that's what she's looking at when she enters this structure. And so this crazy chart is actually today's chart on the 1 minute. And the reason why I chose the 1 minute is because she actually got out for $5. So remember, she bought to open for $2.92. She closed for $5. And that happened on this bar, on the 936 bar. And so knowing Suzanne, I would be willing, and she didn't confirm this with me, I would be willing to bet that she put in a sell to close for $5. That was her profit trigger. And so that means that while price was going crazy at the open, she wasn't trying to necessarily chase a fill. Notice it was starting to come up. That would have been working against her. Then it worked down, came up, worked down. Somewhere in here, she was just okay with letting price do what it had to do to give her $5 fill. And so this was a trade that she did in her advisory group. And so it's a demonstration of what we can do with not necessarily the largest account, but she did it with 5 contracts. And so that means that she made a really nice profit, with capturing profits and making sure that she had that sell to close order in. And so I just want to look at essentially where these strikes would be trading at. And so, ooh, did I do
It
this
looks
wrong?
like you changed strike prices. I thought
Yeah,
you
that's
did
why I
250,
stopped. You know what I think
260.
I did, and I apologize. I think that during, I just had a, dang it, I think I just used the wrong slide. So I really do apologize. Or can I save this? No. I think I do have the wrong slide. So I'm really disappointed in that. And for that, I apologize. Oh, no. No. I don't have the wrong slide. I forgot how I was going to do this. I did change strike prices. And the reason that I did that is because I went on demand to get this option chain from Tuesday, but I didn't have the ability to go on demand to get the option chain from today. And I didn't know that I was going to be presenting a Suzanne trade on Qs. And so what I did was, in changing the strike prices, I'm actually just trying to show the difference in the motion of the underlying. So that's, so sorry about that. In between creating this presentation and then watching Suzanne's lecture and doing the first half, I kind of forgot what my plan was there. So I apologize. I can make this make sense, so I'm about to do that. Suzanne exits when price was trading at about $2.55. She entered when price was trading at $2.62. So my thinking was, if we go back, my thinking was she captured $7 of the move. And so to illustrate that, I'm taking this same option chain and I'm just moving it up $7. So I'm going to move this spread up $7 just to demonstrate the inflation of that price. And so the same way last week, if you were on the call and we talked about how just looking up and down the option chain, you can figure out what your profitability could be. That's what I did for this presentation. So we're going to take 260, we're going to turn it into long at 267. We're going to take the 250, turn it into long at 257. All right. So with that, the 260 price changes from 452 to 822. So it expands. And we just have to use our imagination, as that's where 260 should be if price goes down by 7 points. So if price drops $7, then we should expect the 260 strike to look a lot like the current 267 strike. So that's why we did it in that fashion. And then working against us, what was the 250, which was only $1.45, has now inflated to $3.32. And so that's why at this point we're looking at, if you do the math, it subtracts to $4.90, but Suzanne was able to get out in that moment at $5. I attribute that to somewhat the way that Delta may have been moving for her in that 1 minute bar. And I also attribute that to the influx of volatility that was helping her to expand that contract a little bit. I imagine that, especially given my choppy delivery, this could be a little bit confusing. So I do want to pause for questions, and then I'll continue to try to wrap it up.
So just for clarification, your net message here is the take on that trade was a net $5, or was it the, where'd you start? $5 minus 292 times 5 contracts.
Right. So the net take on that trade is she entered for 292.
Okay.
She
exited at $5.
Yep.
Okay, so $3 and $2 and some change times 5 contracts.
Times 5. Correct.
Okay.
Yep.
And this is a this is, you said a debit spread. Is it it's a put debit spread, right?
This is a put debit spread. And the way that we define that, and the way that we can think of debit versus credit very quickly is, the more we're going to name it by whichever the more expensive contract is. So if I buy, right now I just have these highlighted. So we're going to go with this example. I'm buying for $8.22. I'm selling for $3.32. So really the driver of profit is the more expensive contract. And it's going to behave in the exact, this is super important. A debit spread is going to behave with the exact opposite thesis as a credit spread. So if I want to be bearish and I want to use puts, then I want to use a put debit spread. I can also sell a put credit spread, but that would be a bullish idea. I don't want to talk about that today. We will talk about that soon, but I just want to make sure that that's super, super clear. Fun thing about options is it's such an apropos name. You can use them in so many different ways, but a put debit spread is going to behave like a put. It's going to be bearish. A call debit spread is going to behave like a call. It's going to be bullish.
Got it. Thanks.
Yep.
I have a question. I can understand using the long put leg, but how would you decide what would be the short strike that you would say would be?
Got it. If you have a follow-up, Regina, I'm gonna ask. If you have a follow-up, I'm gonna ask that you put it in the chat. But because your microphone's going in and out, but I think I got your question. Your question is, you understand why we're going with the long, but how do we decide where the short is? I think that's a really important question.
So yes.
Okay. So there's
yes, very.
So there's a couple ways that you decide that. So if I can share my screen one more time, here we go.
Bad internet connection. I'm actually in a hotel.
No, that's
Yes.
okay. Give me a quick yes. Did I get your question? I think I did, and I'm going to answer it, and then we'll go from there. So let's start with the chart. We're picking in this example, and you can really do this any way that you'd like, but we're picking our long call based off of the idea that we want that long call to go in the money. So I want to start there. And so an easy way to do that is to just pick a long put, excuse me. We're picking that long put based off the idea we want it to go in the money. An easy way to do that is to think, well, I'm going to buy this one at the money because it has a statistical 50% chance of expiring with value. So that's what at the money means. Then if I couple that with my technical analysis or any other type of thesis, I'm giving myself an edge in the trade. When you select your short should be indicative of where you think price is actually going to stop dropping. And so Suzanne picked 250. She picked 250. And, obviously she got a huge, huge drop and said, you know what, I've hit my profit trigger. The reason that we want to figure out like, okay, where is price actually going to stop dropping is because once your short is overtaken by price, your profitability in a debit spread is over. And this is super important. It's not going to hurt you. So I used to think when I first started trading spreads, it's like, oh my gosh, if my short gets touched, the moon is going to crash into the world and my account is going to explode. Like I just had, it would like keep me up at night because I didn't fundamentally understand what was happening. Nothing bad will happen if your debit spread goes all the way fully in the money. It won't. What we're scared of is that the short could be assigned. But if the short is assigned, it is the losses from that short. Well, first of all, it's unlikely to just be randomly assigned, but it could happen. If that does happen, the losses from that short are literally covered up by your long. So when you have that long and its deltas are accelerating in your favor, always at a higher rate or equal to the rate of your short, if price really rockets, it's not going to hurt you because your maximum profitability has been achieved. And at that point, the two options are simply going to cancel each other out. But because they're going to cancel each other out, you don't want your short strike to be too close. If your short strike is super close, it's going to take away all of your profits. And so I can explain that by jumping back into the option chain. Okay, so with the option chain, notice that this is why we talked about that difference and that separation in delta. Suzanne was expecting a large enough move that she was going to have 25 deltas working in her favor. If she would have bought 260 and then said, you know what, like I don't want too much risk, so I'm going to pay $4.50 for my long, but I'm going to sell this $2.57 and I'm going to get a really big discount. And I'm going to, my net cost is only going to be about $1.20. Well, that's true because you sold this big discount. So you took $3.31 off of your premium, but 43 delta versus a 35 delta, you would only have 8 cents working in your favor for every dollar that price moved. So you want to have a thesis that says that price is going to give you a large motion. And then you want to look for in the option chain, essentially a discount. So you want to try to find a nice balance where, okay, this is far away, but it's going to give me a nice discount off of my premium. And that's how you start to try to that's sort of the art of trying to select a short strike.
Thank you.
Absolutely.
So Jay, just for clarification, there's then no hard fast rule of thumb then, is what you're saying?
I think the biggest hard fast rule of thumb is in the one that I've heard Suzanne say is that you want to have at least 20 deltas in between them.
Okay.
That's what, and the reason why that sticks with me is I can remember showing her, I was like, oh, I got the coolest trade. And it was like this ratio that made no sense. It's just because there was no risk on it, but there was like, the deltas were so close and she was trying to, and I was like bringing up this, I don't know what I was trying to show her. Like, I thought I had this amazing thing. And she very quickly just looked at the option chain and was like, Jay, your deltas are right on top of each other. And it took, I don't know, she had to say that to me for like 5 minutes before it sunk in. So now that's like in there for me. So I'm passing it on. You want to make sure that you have at least a difference of 20 so that as price is moving in your direction, you can capitalize on it. And so then what I always notice Suzanne do, and we always want to do this in accordance with our psychological and financial risk profile, is then she's going to add on contracts. So rather than just, or not contracts, she's going to add structures. So she's not just going to necessarily buy one. She's liable to buy 5 or liable to buy 10. And so now if you have 20 deltas moving in your favor, but you buy 5 structures, well, now you actually have 100 deltas moving in your favor.
Yeah.
Right? Also, you have 100 deltas moving not in your favor. So that's why, you just always have to weigh that out. But for me, the way that I always like to look at it is I'm trying to, the first thing I'm doing is finding a long position that makes sense to me. Like, hey, I think this thing is going to go in the money and expand in my favor. Because if I'm doing a debit spread, then I need that long to be my driver of profit. That's actually, the long is my driver of profit. If price goes in the direction of my thesis, then I'm making money. If price goes against the direction of my thesis, that long is what's going to fade and where I'm going to take a loss. The short is going to mitigate that loss, because if price goes against me, the short is actually going to make money. It just can't make money as fast as the long can because it's further away from current price.
Thanks.
Absolutely. Yeah, Regina, so you're buying the vertical on a put debit spread, correct? Credit spreads give you credits. And so to emphasize what that means, when we enter a debit spread, we're paying a premium to enter. That premium is our max loss on the spread. And let's stick with debits for a moment. The easy way to calculate, I'll jump back into, no, I won't. The easy way to calculate max profit is to look at the width of the spread first. So Suzanne was trading a 10-point spread. Her max profit on that trade is the entire width of that spread. So that means that that entire width of her spread should give her $10 of profit. However, she paid a debit to enter. She paid $2.92 to enter. So that debit that she paid is taken away from her max possible profit. So if my math is correct at this late stage in the night for me, who's been up all day, it's $7.08 is her max profit. So her max risk is $2.92. Her max profit is $7.08. And the reason why is that long at 260, when it gets down to 250, it can't make money anymore. So the max profit that she can get is those 10 points. If she would have done a 5-point spread, her max profit would only be the $5. If she would have done 15, her max profit would be 15. And so the easy way to see maximum reward versus maximum risk is to say, what's my debit? My debit is my max loss. Hopefully, when we trade, we should manage a trade before we just take a max loss. But we should always have in our mind, absolute worst case scenario, price just does something insane and I can't get out. This is what my max loss is. But at the same time, max profit, we need to know what that max profit is. And so if we can keep that in our mind and allow that idea to be one that's just sort of there for us, when it comes time to structure a butterfly gets super simple. And we won't get into the butterfly weeds yet today, but when we start to understand like just the width of spreads and what they actually mean, then when we start playing with them and doing, 3-leg strategies, it gets super simple to conceptualize. So for today, the big thing I want everyone to walk away with is that debit spread. The max gain is going to be the width of the spread. How far are those strikes apart from each other? The max loss is going to be the debit that you pay to enter it. So as always, and if there are more questions, great. Please fire away at the questions. But as always, I really enjoy this. I'm looking forward to getting better as a presenter. Before we close, I would love everybody's feedback, or whoever would like to share it. So if you would like to in the chat, just drop down what are the #1 things that you learned today, or if there's some things that are still not clear, like, hey, Jay, can, maybe next time think about teaching it like this. I would love for that feedback as well. Greg, thanks a lot. Also, please, by all means, feel free to come off mute. But at this time, I'd love to see what's the #1 thing that people were learning today.
Thank you for reminding me about the difference in the deltas on the debit spreads, because sometimes I would do that when I'm just trying to not spend so much money. I would like narrow the width. And so thank you for that makes so much sense, telling the distance of the deltas. So that was very helpful. Thank you.
Excellent. Glad that was helpful. All right, TR, I appreciate that. Making sure that we enter at an appropriate time. All right, so a lot of talk about the delta. I'm really glad that we've had. Cool, pay more. Oh, and paying attention to SPY. So in terms of paying attention to SPY, you can do it any way that you would like. So if you wanted to track SPY by watching, the ES, watching futures, do it that way. Do it by looking at SPX, or do it by looking at SPY, because SPY is just following SPX. And sometimes I like to play around, especially if you like to get into volume profile. It's fun to kind of look at what does volume profile say on SPY versus maybe what volume profile is saying on ES. That can be helpful, but just know and understand that this was also something that I didn't know when I first started trading, was that SPX, SPY, and ES are the same thing. Like, they're important to look at, but just really understanding that they're the same thing. Am I getting into long put after this run for further out expirations? Well, not yet. Not yet. I will tell you what I'm looking at. And I'll tell you that I'm very cautiously looking. So, oh wait, you can't see my screen. Sorry about that. So first of all, to me, seeing a move like this, which Suzanne alluded to, we essentially saw an entire week's worth of price action in 1 week. And so in some ways you might one might think to themselves, I know that I had a voice that said like, oh, well, we already moved that. There was our move. Let's just go ahead and fade it. I don't think that that makes a whole lot of sense. I'd like to see how we behave at this gap. I don't take this wick very seriously right here. I think that that was just somebody who had a bad order in that the broker cleared on non-farm payroll. So I view this as a true gap between these two candles. So I'd like to see how price behaves here. You know, does price want to fill this gap before it wants to come down? Does price want to maybe take out some highs before it wants to come down? Notice that my macro bias is bearish, but right now, given this big move, I have to be careful and kind of really figure out where is the next leg down. So I won't just be entering short on tomorrow. Also, I'll be really paying attention to the Telegram with Suzanne letting us know about the option chain. I mean, I remember as if it feels like a long time ago when we had this little run. And I don't think Suzanne said anything on this Tuesday necessarily. I think it was the Monday where she was basically talking about this wall. And we got a little bit above it. And I wish I could remember the exact strikes, but I know based off of what she was saying on Monday that she was not thinking long when we had this big run up. And so I will be paying attention to what Suzanne says regarding the option chain, trying to figure out where we're headed. She said that right now, you know, in terms of big structural resistance, it actually isn't until all the way up here on S&P 500. It'd be the 4,000, but that's 400 in SPY. Does that mean that I'm just long until we get there? No, because there's a lot of data points to have to think about. Oh, okay. I'm seeing some stuff in the. Yeah, Greg. So you're saying right here looks
So I
like a
would say,
seller's.
yeah, that looks like sellers gaps right there. And even if you look behind the Monday, Tuesday Monday, Tuesday you were talking about, you've got
Yep.
more sellers more sellers waiting right there.
No, I cannot argue with that. It's for sure looks like sellers are lying in the wait. Me personally, like my trading style, I do like to fade moves. So
What does that mean? Just for
what
clarity.
that means is that I don't like to trade breakouts. So when we had this huge gap down, I didn't, you know, I was like, okay, I might have to go short right now, but I didn't want to. So, you know, because what I like to do is sort of anticipate where I think price is going to turn, try to watch for some confirmation, and then, you know, enter a swing. And it's always in terms of balancing, like I might be, you know, teaching a class at that time. And so I've actually gotten better this year. I used to be terrible at it, but I've gotten better this year of having alerts that I'll actually trade even if I am teaching. And I've gotten to a place with the kids that I teach where they know I'll be fast. It's not like I stop teaching for like 5 minutes or something. I'll just say like, hey guys, I got to check this, and I'll tell them to work on something independently. And then I'll enter the trade. And then after class, sometimes I'll have to realize like, oh, I shouldn't have done that. You know, I'll take a small loss. And then sometimes I'll get some more confirmation afterwards. But my personality as a trader, I've just sort of come to accept. Yes, I do see this as it could be resistant, but who I am, I can't just put like a limit order there that says like, okay, well, buy a put because price hit this level. Even though it might respect it, it really might. My personality still has to look at it, you know, look at it on a smaller time frame, look at what ticks are doing, and try to get some context where I feel like I'm making an informed move. I don't think that that's better. I think that, playing probabilities in your favor is the way to go. It's just me accepting who I am as a person and how that influences my trading. Yeah, TR says, waiting on that morning brief. Yeah, Suzanne's morning briefs are amazing. It's like I'll have my whole chart and then she says something and I'm like, all right, well, and now I have to erase my chart. Start over. All right, so it's been a pleasure as always. I believe next week we're going to start to talk about, I got to see how she has it outlined in the curriculum to make sure I'm correct. I think it's going to be short calls, which will actually dovetail really nicely with this conversation. And just like we've talked about buying options, next week we'll talk about selling options, and that'll dovetail really nicely with spreads. So we'll be able to talk a little bit about spreads, but I always want to keep the beginning part of the lecture to, if you're new and you're not sure how options function yet, then I want to make sure that I give a really clear foundation there. Oh man, Darius. Oh man. Thank you for being here, Darius. And thank you for that clarification. Thanks a lot. I really appreciate that. And so yeah, what fade, just to just emphasize what Darius says, when we talk about fading, we are anticipating a price reversal. And so Darius gave a great breakdown in the comments, but that's the idea, is price is moving in one direction and we want to take the opposite perspective. Mabel, thank you. Oh, Carla, I didn't see the question. Oh, how far out do we buy debit spreads generally? You want to find almost like a Goldilocks. You don't want to pay for time in the same, this is the way I should say it. You generally don't want to pay for time in the same way that you would buy a long option. And the reason why is, if you put that debit spread out for too much time, then you can see your price move, but the option that you sold will still have so much value in it, still have so much extrinsic value baked into it, that it gains so much against you that it really eats into your profits. So I think that, Suzanne's example, I think that she was looking at about, Greg, thanks a lot. Have a great night. She was looking at about a week out. To me, debit spreads make the most sense. Not much more than a week. That's the way that I trade them. There are some great traders on here. Darius might have something else to say about that, but I would look at it as, I'm trying to capitalize on a move that's happening, in the next day or two. I'm going to give myself a little bit more time in case price chops around sideways. And while price is chopping around sideways, that short that I sold is going to help sort of stabilize price for me. But I don't want to pay for too much time, because I want price to sort of go through that spread and let me get out in profit. I hope that answered the question. I felt super babbly when I said that. All right, cool. Juanita, thank you very much. All right, everybody. See you next week. As always, reach out with any type of questions. There's amazing traders on here. Vicky's an awesome trader. Darius, like she said, he's absolutely legendary. Greg is phenomenal. There's just a wealth of information in this group. We're always happy to help each other. Thanks a lot. And everybody have a great Friday, a great weekend of planning, and looking forward to next week. All right, everybody, good night.
Night, Jay.
Night.